It's a great pleasure to be here with you this morning. I must apologize for speaking in English. You would not want to hear my Italian. So I don't need to tell you that 6 years ago, 7 years ago, the world went through a terrible financial crisis. Indeed, clearly the worst financial crisis since the Wall Street crash of 1929. And that led to a very deep recession, indeed the deepest recession since the 1930s. It's fair to say that the world has not yet recovered from that financial crisis and recession. The U.S. is making steady progress, although it's not back to normal yet. Unemployment is still above the unemployment levels of 2007. Worse than that, in Europe in particular, many countries are stagnating or perhaps even moving backwards. So Italy, for example, may be moving into recession. Looking at other parts of the world, we see Japan, once the second biggest economy in the world, floundering. This is nothing new for Japan. It's been doing that for 20 years, but once again they seem to be moving into recession. The emerging economies, the dynamic economies of China, Brazil, and India are no longer growing at the same rate they were a few years ago, and there's good reason for that. They're all heavily reliant on Europe, and if Europe's not doing so well, they won't do so well either. Russia, we know, has special circumstances. They've relied very heavily on oil. Oil is not doing so well at the moment. Also, Russia has suffered from the political sanctions that were placed on it due to their involvement in Ukraine. Africa actually is one part of the world where potentially there's a bright spot. Parts of Africa are actually doing pretty well, finally, after many years of investment effort. But they of course have a long way to go. Africa is the poorest part of the world, and they have enormous ground to make up to get to the levels of even China, Brazil, and India. Furthermore, the Ebola crisis in Western Africa is going to set back that part of Africa for many years to come. So all of this leads to some questions. First, how did we get into this problem in the first place? What caused the financial crisis? What caused the recession that followed that crisis? Why has recovery from the crisis and from the recession been so slow? Is there anything that we can do to hasten the pace, to speed things up? And finally, what are the prospects, the economic prospects for the future? Well, those are a lot of questions, and I don't have an enormous amount of time this morning, but I would like to touch on each of them at least briefly, and so I will spend the rest of my talk trying to provide some answers to these questions. Well, the start of the whole problem was the collapse of financial markets in the period between 2007 and 2009. Why are financial markets so critical? Well, we rely on financial markets basically to finance innovation. that's where growth comes from innovation, and financial markets provide the way forward for innovation. So when finance collapses, so does innovation. And for that matter, many industries rely on finance just to balance their books from week to week. They due to the timing of inputs versus outputs, they need credits in order to pay their workers, pay for other inputs before their revenues come in. So the financial crash was extremely disruptive to the economy. But the point that I want to emphasize about financial markets is, unlike other markets, financial markets do not work well left entirely on their own. They have to be adequately regulated, and I will explain why. Well, first, how do financial markets work? Probably all of you know quite a lot about financial markets, but let's go through a very simple version of how finance works. First of all, there are entrepreneurs. Entrepreneurs have ideas for investments, but they don't have money. They have to go to someone else to get the money to fund these ideas. Who do they go to? They go to banks, and I'll use banks as a catch-all term for any financial institution which invests in innovation. Banks have at least some money, and they also have the ability, to some extent, to evaluate ideas, so they can tell what's a good idea, what's a not so good idea, at least to some extent. And they will try to lend money to good ideas. Now, of course, it's more complicated than that, because typically a bank will not have enough money to fund all of the ideas that it would like to fund. So what banks typically do is themselves to borrow money from other banks or from other investors. This is what's called leveraging an investment, when you put not only your own money into it, but you put other people's money in. You're leveraging your investments. And that can be a very good thing for a bank. It can increase the bank's payoff considerably. For example, suppose that you're a bank and there's an idea which will give you a 20% return if you put some money into it. If you put $100 of your own money into it, you will expect to get $120 back. That's a 20% return. But if you also put $900 of other banks' money into the project, now you're expecting to get back $1,200. You'll have to pay off the banks who have lent you the $900, so you repay them $900. You've got $300 left over. That's a 200% return on your own money. Not bad. So that's because of leverage. It's good for the bank. It gives the bank a higher payoff. It can be very good for the whole economy because it allows more good ideas to be funded. It allows the money to be spread around more. And that can be good for innovation. And innovation leads to growth. In fact, one great advantage of the American and European financial systems is that they do allow for a great deal of leverage, for funding a large number of good ideas. This gives them an advantage over more primitive financial systems that we see, for example, in the BRIC countries. But there's a downside. This greater leverage leaves them more vulnerable to collapse than in more primitive systems. So let me go into how this vulnerability to collapse arises. So far in my discussion, I've omitted one very important factor, and that's risk. When a bank invests in a new idea, in an entrepreneur's new idea, typically that idea is not a sure thing. It may pay off, but it may not pay off. So in effect, the bank is making a bet that it will pay off. If the bank also leverages its loan, it's in fact increasing its risk. If it invests $100 of its own money and it loses the bet, well, it's lost just $100. But if it's also borrowed $900 of other banks' money, now if the bet goes bad, it's lost $1,000, which means that a highly leveraged bank may fail, may go under if it loses a highly leveraged bet or two. Now, what is the danger of bank failure? Well, if the problem were confined to the bank making the loan, we wouldn't worry so much. You know, a bank takes a risk when it arranges its loan portfolio. It knows that there's some chance that things won't work out. It's willing to take that risk. It's done the calculations. But the problem with leverage is that other banks are affected too. So if the loan goes bad, if the new idea fails, then the bank that lent to that idea, made the loan, fails. But if that bank also borrowed money from other banks, now they too might fail. In other words, we can have a chain reaction of failure due to leverage. That's what we call systematic risk. That is the danger of leverage, that you have a chain reaction of failures, which ends up paralyzing the credit market. So all this suggests a central way in which financial markets differ from most other kinds of markets. In financial markets, we can start with a small problem. In the case of the 2007-2008 crisis, it was a problem in the subprime mortgage loan market, which subprime mortgages were just a small part, maybe 1/10 of the whole mortgage market, and the mortgage market itself was only a small part of the overall credit markets. Nevertheless, the problem in the subprime mortgage market, which was small relative to the entire market, grew and ended up enveloping the entire financial market. So that is something that can happen in financial markets. It doesn't happen in other markets so much. To take a humble contrast, look at the potato market. The potato market is also a market. If we have some failures in the potato market, some potato growers lose their crops, what will happen? Well, if there's a fall in potato supply, there will be an immediate price rise, and that will cause other potato growers to step in and expand output, and that will address the initial fall in potato supply. So the problem is self-corrected within the potato market. There is no need for government intervention in the potato market. The problem corrects itself through prices and through output expansions. The government might try to interfere in the potato market. They might see the potato prices going up, and so they will say, well, we're going to put a limit on how high potato prices can go, or we will tax the profits of potato growers, these windfall profits that they're getting because of the very high potato prices. those might be well-intentioned policy responses, but they are misguided policy responses because they discourage the very expansion of output that is needed to correct the problem. So we don't want government intervention in the potato market. But what about government intervention in banking? Well, this problem of bank failure is not self-correcting. As I argued, you can have a chain reaction of failures because of leverage in which basically the entire credit market is involved. And somehow you want to stop that chain reaction before it has paralyzed credits. Well, how can you do that? Well, in 2008, 2009, we had a number of bailouts. They were regrettable, but they were necessary to stop the chain reaction. And the point about these bailouts was that they were not so much to save the banks who were about to fail. The more important reason was to prevent other banks further down the line from getting into trouble. So you save some banks in order to prevent other banks from getting into trouble. Now, another way that financial markets and potato markets differ is that if I'm a potato grower and I lose my potato crop, I don't put other potato growers in jeopardy. In fact, if anything, they're going to be in a stronger position if I lose my potatoes because they can now sell their potatoes at a higher price. But in financial markets, as I've been discussing, one bank's potential failure can put other banks in trouble. And the problem is that I, as a bank, don't have the incentive to take into account the risk that I am imposing on you when I take risky actions. That means that I'm, in effect, exerting what economists call a negative externality on other banks. When I increase my leverage, when I increase the riskiness of the loans that I make, I'm affecting not just me, I'm affecting these other banks, but I don't have any incentive to worry about these other banks. We know from economic theory that in markets where there are large negative externalities, those markets are not going to work well on their own. There has to be regulation to limit the risks and limit the leverage. A good analogy can be made with the market for clean air. If I'm a polluter, I produce steel and I put a lot of smoke into the air, I don't have any incentive. The market doesn't give me any incentive to stop putting smoke in the air. Because I don't take into account the negative effect that smoke has on other people or on other companies. How do we ensure that there's not too much smoke? Well, there has to be regulation. There have to be rules which place a limit on how much smoke I can emit or impose a fine on me if I emit this smoke. Same thing is true in the financial markets. As I've argued, banks have an incentive to act in too risky a way, too risky for the stability of the financial system. They make loans that are too risky and they take on too much leverage. And so there has to be some limit to that imposed by government. Government can intervene by putting minimum standards on loans, that is, making sure that subprime loans, for example, meet certain standards, also, and this is the most important thing of all, limiting leverage, imposing capital requirements on banks. So in my view, the main reason why we had a financial crisis was that this simple lesson about externalities from economics was ignored. We have this famous quotation from Alan Greenspan, who was the previous chairman of the Federal Reserve, who said that in his view, financial markets are self-regulating. Well, there are very good reasons why financial markets are not self-regulating, and that was his big mistake. It's wrong. It's certainly wrong in practice. We saw that they didn't regulate, but it's also wrong in theory. The economic theory explains very clearly why we should never have expected financial markets to be self-regulating. Now, clearly, regulation was inadequate before the crisis. There had been a fair amount of financial regulation put in place in the 1930s. A famous example of that in the U.S. was the Glass-Steagall Act. Some of this regulation was simply dismantled over time. For example, the Glass-Steagall Act was repealed in the 1990s. A lot of regulation simply became outdated because we now have many economic institutions which simply didn't exist at the time that the 1930s legislation was being created. For example, we have hedge funds now. Hedge funds are not covered by most of this bank regulation. And then we also had cases where financial regulators could have stopped what was going on, that there was adequate regulation, for example, to do something about subprime mortgages, but those rules were not actually being enforced. Nevertheless, I think there's some reason to be cautiously optimistic about the financial future. At least for the short to medium term, I think the chance of another financial collapse is pretty low. First, because the memory of this collapse is so recent that banks have been behaving more conservatively, and leverage is much lower on average than it was in the years leading up to the crisis. So we haven't got back to those danger zones that we were achieving in 2005, 2006. Also, there have been some useful steps to improve leverage. In the United States, we had the Dodd-Frank Act, which was a financial reform bill, which limits leverage, provides for stress tests. Basel III in Europe has taken some useful steps in the right direction. I think it's fair to say that it hasn't gone far enough, but at least moving in the right direction is cause for optimism. Clearly, we have to do more to improve regulation for the next time leverage ratios get to unhealthy levels. We have some time to do this, but not an indefinite amount of time. And one important thing to remember is every time you make financial reforms, regulatory reforms, you have to remember to update them because the financial markets change, the regulations have to be modified over time to keep up with those changes. Otherwise, they become completely outmoded. Well, the people who oppose regulation say effective regulation will make the U.S. and Europe less dynamic financially, and that's probably true. There is a balance to be struck between innovation and stability, but history shows that it is possible to make that kind of balance. There was a period of about 40 years between 1940 and 1980 where there was pretty tight regulation. We didn't have any terribly serious financial crises in that period, and pretty good growth at the same time. So getting the balance right is not impossible. And today, I like to use Canada as an example of a country which is getting it more or less right now. That they had very tough limits on leverage in the period leading up to the financial crisis, and interestingly, they had almost no bank failures as a result. They also had good growth. So they prove that we can get the balance correct. Now, as I said, the financial crisis was serious not just in itself, but because it induced a very deep recession. Why did this occur? Well, the short answer is that the financial crisis destroyed an enormous amount of wealth. People were now considerably poorer than they were, and when people become poorer, they reduce their demand. And so demand dropped precipitously, and with a drop in demand, there was a drop in output, a drop in employment, and we got into a vicious cycle. We got into a situation in which there was lower employment. The lower employment meant lower demands. Lower demands meant lower investment. We got trapped in a low output, low employment equilibrium. Why has the recovery from this low level equilibrium been so slow? Well, one answer is that it was a very serious recession. And serious recessions do take time to recover from. This, as I said, was the worst recession since the 1930s. But I think more could have been done to promote recovery. I think there was some rather serious policy mismanagement, and I'll say a few words about that. We've known for over 80 years that when an economy is stuck in a low-level equilibrium, low output, low employment, that government can take a role to pushing the economy out of that low level by fiscal stimulus, by government spending, government investment. Now, this only works when there's excess capacity. If the government tries to do this when the economy is fully employed, it tends to produce inflation, and it tends to crowd out private investment. But if there's excess capacity, propping up demand, government spending and investment can be a very useful policy. Now, of course, the government may not have all the money to do the spending and investment. In that case, it can run a deficit and pay back the deficit when the economy recovers. So that's the fiscal side. On the monetary side, the central bank should keep interest rates low to promote investment. And if necessary, the central bank should even create more liquidity by buying securities. both these policies, the fiscal policy and the monetary policy, were followed in the United States. The fiscal policy was followed for a couple of years, and then basically the U.S. federal government got paralyzed, and very little has been done since then. But at least for a couple of years, there was a very large fiscal stimulus, an $800 billion. That's a misprint on the slide. It should be an $800 billion stimulus, nearly $1 trillion of stimulus in 2009, 2010, and simultaneously a major and quite creative push by the U.S. Central Bank, the Federal Reserve, to create quantitative easing. And these policies worked. The U.S. has made a slow but nevertheless steady recovery, and it continues to get strength to a point where now, as compared to unemployment of over 10% in 2009, unemployment is now below 6%. Unfortunately, the story has been quite different in Europe. Little fiscal stimulus. In fact, to the contrary, we've seen an attempt to do just the opposite, to impose what's called austerity measures, where public spending is actually cut. And on the monetary side, the ECB was slow to adopt accommodating monetary policy. Now, I give Mario Draghi a lot of credit. Since he's been at the helm, he has been a vigorous leader at the ECB, and he's done what he can. But he came in a bit late. He came in toward the end of 2011, and there's a limit to what he can do. The ECB is more limited in its policy options, say, than the U.S. Federal Reserve. So, for example, it would be nice if Europe had Eurobonds. That would help, but it doesn't, at least not yet. It would be nice if the various fiscal authorities in Europe cooperated with one another. They don't cooperate very well, and so that has been a problem. And as we've seen, Europe has not made such a good recovery. Now, people will say, well, the European situation is difficult because many countries, Italy is one of them, have high debt to GDP ratios. And, of course, high debt can act to slow the economy down. And so it's desirable to reduce debt. That's true, but nevertheless, at a time of excess capacity, at a time of high unemployment and unused capital capacity, cutting government spending can have exactly the wrong effect. It can be counterproductive because it reduces economic activity and therefore tax revenue, and therefore makes the debt problem even worse. And we have some important historical examples of that. After World War I, Great Britain had amassed an enormous war debt, which it tried to reduce by cutting government spending, and indeed it did cut government spending quite dramatically after the war. It immediately went into a terrible recession. Now, by contrast, at the end of World War II, the United States also had a very high debt because of war spending. It had a debt to GDP ratio which is similar to the one that Italy has now, somewhere in the high 120s, low 130s. But debt was not a big political issue in the U.S. at the time. It was not something that people worried about. What they were worried about was getting the economy moving again, and within 10 years, the debt problem in the U.S. was solved by growth. One more example about debt. When Franklin Roosevelt came in 1933, he immediately started a stimulus program, a public works program, to try to prop up demand. And in fact, between 1933 and 1936, unemployment fell by about half. It was at 25% in 1933. It was down to around 12% in 1936. But at that point, there was a shift in Congress. More conservative Congress came in. They cut government spending, and a lot of the gains that were seen in the years 33 to 36 were reversed, and there was actually an increase in unemployment in 1937. That increase in unemployment was actually not finally resolved until World War II, which was the biggest stimulus plan the world has ever seen. It's a very destructive stimulus plan. I'm not recommending a war to stimulate the economy, but it did ultimately solve the American unemployment problem. One thing to remember is that even though there are some European countries, such as Italy, which have high debt to GDP ratios, Europe as a whole does not have this problem. And that suggests that some coordination, some centralization of fiscal policy in Europe is very much needed. Europe is benefiting from a centralized monetary policy. The European Central Bank, at least recently, has been providing wise monetary leadership, but there's no centralized fiscal policy. And that kind of mismatch between fiscal and monetary policy that is, in my view, not sustainable in the long run, and it makes life for countries who would like to be able to devalue, for example, but can't devalue, very difficult. So what should Europe do? This is my personal view, but I think there are plenty of people who share a lot of my viewpoints. First, stop obsessing about debt and focus on recovery. Make the investments needed to get the economy going again. And coordinate fiscal policy to make that possible. So that, if Italy has a debt problem, there will be automatic transfers from other countries which don't have debt problems, so that Italy doesn't have to worry for the time being about debt. It can get its economy going again and pay back the debt later. Even better to have, if there could be a centralized European fiscal authority, that would be better still. Now, of course, simply redoing monetary and fiscal policy is not enough. There are economic reforms that need to be made too. So you're well aware that there are rigidities in the Italian labor market. It's too hard to hire and lay off workers. It's important that something be done about that. It's too It's too hard to create new companies. Getting rid of bureaucratic impediments to labor markets and to entrepreneurial activity is very worthwhile. And all of this leads to investment. In my view, investment is the key to getting out of recession. It's important that both public and private investment be directed toward ventures which will create growth, and growth will ultimately solve all these debt problems. So what are the big investment opportunities? Well, with low interest rates, a need for greater demand, investing in infrastructure is an obvious way to go. So I wish my own government, the U.S. government, would be investing in infrastructure. This is a wonderful opportunity because interest rates are so low and because there is so much infrastructure which has deteriorated. Same is true in Europe. It's good for the economy as a whole, and it's important for the long run that these infrastructure investments be made. We've seen quite recently a renewed interest in climate change. There was a historic agreement, largely symbolic agreement, but a historic agreement between the U.S. and China recently, suggesting that maybe finally we're going to get some kind of effective global carbon emissions treaty in place. There's a big meeting in Paris next year. That may be too soon to expect to get a result, but within a few years, I think it's pretty likely we will have a result. And that means that investing in alternative energy is going to be a wonderful opportunity. Solar energy, nuclear energy, biomass, etc. And then finally, we've all heard the talk about rising inequality around the world, in Europe, in the United States, in developing countries. The most effective cure for inequality is not to bring down the rich, but to raise up the poor. And the way that we do this is to invest in job training and invest in education. And I think if there's one investment that is most important, maybe I'm biased because I'm an educator myself, it's the investment in education. And with those observations, let me stop and thank you very much for your attention.